Hey everyone, welcome back to the channel. I'm Dennis, and today we're going to be doing a deep dive into something that every single person can be doing, building wealth through investing. Now, you don't need a six-figure income. You don't need to time the market like we've seen. You just need the right steps, and really consistency is what we're going to be looking at today. And I want to give you some insight into exactly how I've done this, how I've built over a six-figure portfolio. And in this live session, I want to break down my 7 steps that we can do this, exactly how average people can build wealth. If you have questions, definitely drop them in the chat. We can look at those. So grab a notebook or your phone, because you're going to want a roadmap of what you can follow when it comes to the investing journey. And of course, like I said, if you have any questions, drop them in the chat. We can cover them as we go. So of course, this is the first one, and this is one of the absolute most important, is the mastering of the wealth mindset. This is something that I did not do when I started investing. It took me probably about 30, 35 years of age before I actually got into the right mindset of looking at, before I'm ever buying my first stocks, which I started about 18, before I started investing into ETFs. Wealth starts in the mindset. It is the mindset. You don't think about becoming rich, and the rich don't think about the income. And of course, you think about assets. Now, again, when it comes to investing, it gets to a point where it's almost gamified. When we look at Robinhood, when you look at M1 Finance, when you look at investing, that's the reason why we're seeing such a huge popularity with kind of gamifying investment. And it is about the accumulation of assets. Again, this is something that I wish I knew in my early 20s, is the more that you own, the more companies you own, the more assets you possess, the greater wealth generation you're going to have. And of course, when we get into compounding, it is incredible to see just how much big and how fast this snowball can be rolling. Now, every dollar that you earn has a job. I look, and really, when you look at Ramit, when you look at Dave Ramsey, when you look at Morgan Housel, there are so many different ways to kind of spin and talk about the exact same story. When Dave Ramsey talks about every dollar has a purpose, it's really to invest it, to create more dollars out of the dollars that you're earning. That is really the shift. When you make the shift from being a consumer, so you're going to Walmart, you're buying things, you're going to Target, you're buying all of these streaming services, you are a consumer, but flipping the script and taking the other side and starting to be an investor. When I start thinking about NVIDIA, I have their chips in my GPUs, I use them in my computers. I am also a shareholder in NVIDIA. I do the same for Apple. I use Apple products, Apple phones. I have a tablet. I own a percentage of Apple. Even though it's a very small percent, it is still a percentage nonetheless. So looking at owning something like the S&P 500, you are practically investing into every company that is the touch point as a consumer that you're investing in. Again, when you start thinking of where you go grocery shopping, chances are a majority of those companies are publicly traded companies. If you're owning something like the S&P 500, or even looking at the VTI with the total index, chances are, if it is a publicly traded company, you are now owning a piece of that company. Now, that really makes a big difference. And again, this is where a lot of the mindset shifts, because if you're an owner of that company, a majority of companies do pay dividends. Could be a high dividend, could be a low dividend, but usually they will give money back to their shareholders in the form of dividends. If they don't, they do it in the course of increasing stock value. So if you are an investor, if you are an owner of these companies that you're using on a regular basis, chances are you're getting some of your money back from the consumption side through the investing side of these companies you own. So really asking yourself, is a purchase going to help me build wealth or keep me from it? Again, this is where really eye-opening, really changing when it comes to the psychology of money, which we have, I believe it is right back here on my bookcase. But when you look at psychology of money and you look at a dollar, and this is the exact same way, even thinking of Warren Buffett, is if I use a dollar to purchase something, let's say I go buy a coffee and it's a dollar, that is a dollar that I don't have on my future. That is a dollar that I'm giving away of time, whether I have to work a 9-to-5 job to earn that dollar, or is it a dollar that can purchase time, that can build wealth, that can generate into more dollars? So it really takes in a conscious effort of thinking about what you need to have, what you need to purchase, what you need to own. And again, going back to the fundamentals, it is assets. when you're owning pieces of companies, it is really a wealth mindset when you're purchasing assets, and the game is the accumulation of assets. So honestly, if you have more of a wealth mindset, drop it in the chat. Let me know. Are you more on the investor side? Are you more on the spender side? And again, this is going to be really different depending on where you are in your life. Me personally, looking at the age of 18 to probably 35, like I said, I was a really big spender. I had some credit card debt, I had some student loan debt, and it got to a point where I realized through education, through financial literacy, that carrying that debt was taking away my time. If I'm an individual that's earning, let's say, for instance, $20 an hour, and I'm paying $100 every single month for interest on my vehicle, that is 5 hours I am working every single month just to pay that interest bill for the vehicle I have. And that was the point where it really flipped the script, and it changed the mentality and really the wealth mindset that I had of looking at vehicles, looking at investing, looking at owning assets versus having stuff and having liabilities. It really did make a big difference. So wealth is really how you start thinking about it, but growing it is really what you do next. Now, when we start looking at the growth aspect, we start looking at building a solid financial foundation. We talk about this a lot when it comes to financial education. And for me, I do financial counseling professionally through my credit union. Here's the truth. You can never invest your way out of bad money habits. I see individuals that are making $50K a year that save a majority of their income. I see individuals that make $200,000 a year and are literally paycheck to paycheck dead broke or even underwater. Now, wealth needs a very strong base. So when we start talking about building that foundational base, there are really two big steps. First step, financial education, financial counseling, is paying off high interest debt. Anything that you break into debt, whether it's good debt or bad debt, you want to break them kind of into two categories. Now, the way that we kind of disseminate this is good debt is something that is going to build assets, that is going to create possibly more cash flow in your life. For instance, if you're going to school and you're getting an education, for some of us, the education might be paid for. I joined the Marine Corps years ago to get my education paid for, but for a lot of us, student loans. Now, if your student loans, I treat this as good debt. If the student loans are going to put you in a position to earn a lot more income through the education that you're paying for, even though it is student loans, honestly, it's kind of crazy. Now, bad debt, anything usually above 8% they coin as bad debt. Thinking of credit cards, 20, 24, 26% interest on a credit card is just absolutely crushing your ability 100% to generate wealth in any manner. That really means that you're living outside of your means. If you're making $50,000 a year and you're spending 52 or 55 or even 60, that is going to catch up with you. That is going to catch up with you even faster as those credit card balances start getting higher. When you start getting to $3,000, $5,000, $10,000, the interest on credit cards start running at such an astronomical rate. That is why the minimum payments are so low, is the interest works in the exact opposite of that we have for compounding, is the compounding of debt versus the compounding of assets when we start investing. Now, of course, number two, building that emergency fund. At the very beginning, emergency fund, my recommendation is just kind of the baby emergency fund. I know Dave Ramsey says $1,000. I know the money guys, they talk about specifically covering your deductible. I'm looking for 1 month. 1 month is the baseline. When it comes to the emergency fund, you are going to start with 1 month, because what's going to happen is if you start with that first step and you're focused on building out that emergency fund and you do it for 3 to 6 months, it could take you an absorbent amount of time to get to that 3 to 6 months of saving money, especially if you do have that high interest debt, if anything is running. So again, first one, save up that little bit of an emergency fund. That way you have something to fall back on and you're not reliant on the actual credit cards that a lot of people are using to fund that emergency fund. And then, of course, get control of the cash flow. Every dollar needs a purpose. This is so important. And again, once I sat down, once I developed a budget, once I built a budget, I could see some exact levers that I could kind of pull and manipulate to change the cash flow that I have, even eliminating some of those debts, eliminating some of those loans like a car payment. and being able to move those assets or move those dollars into additional assets, being able to invest in the portfolio a lot faster. Now, once you've gotten that stability, then we start looking at building real wealth. So what does it mean? So once we have that foundation in place, this is where it gets into the investing side. This is where the fun begins. It is growing your money through investing, which is huge. Now, when we start thinking about the investing aspect, even if it's small, I always say individuals, get started, guys. We have links. We have the links down below in a couple of videos for Robinhood. We have it for M1 Finance. Regardless of where you're putting your money, starting even if it is small, I'm talking $50, $100, even $5, $10. Starting small gets you started. This is the point when I do financial education and counseling where most people get stuck. They think I'll invest when I start having money. So they wait for that point. They already want to have money prior to investing. But here's the truth. You will get more money through investing if you already eliminated the debt, like we talked about, that really high interest bad debt. If that is gone, you're going to get money to invest, and you will have money to invest because you're freeing up that cash flow. Start small. Again, $50, $100 a month into a low-cost index fund. An ETF like VOO is going to get you in the door. It is going to get you in the game. And right off the bat, starting and really shifting that mindset is you're going to start looking at things as an investor. Now, when we start looking at this, you could possibly even look at how can I save a couple extra dollars? And again, thinking of the gamification of everything that we're seeing, if you put $50 into something like the VOO, absolutely it's going to perform well over an extended amount of time. But if you can put $50, every single month for the next 12 months, even bump it up, let's say by the end of the year, you're putting $100 in there every single month, this can absolutely change the trajectory of your financial future and really your life in general. When we're talking about those low, simple, broad index funds, again, the VOO, SCHD, which again, I'm not too big on the income right there, but even the JEPY, the JEPY, and there are a lot of variations about this. A lot of people will ask, when it comes to something like the VOO, what if I'm doing, the SPY? They're both funds. They both track the S&P 500. They're very similar. There are a lot of different countries I know that have very similar funds that do the exact same thing, tracking that S&P 500. You are not trying to beat the market. You are trying to own the market. Think about that for a minute. If you're looking to beat the market, and when you look at an extended amount of time, talking a 30-year runway, 99% of investors will never beat the market itself, which is kind of crazy. They might have 1 or 2 years they do incredibly well. But when you look at an extended amount of time, you are not going to beat the market. It's been proven through so many things. Again, you might have a one-off 1% person that can beat the market consistently year over year over year. But for a majority of us, including myself, VOO is the foundation that I use for my 3 ETF portfolio. And it is something that I've held for a multitude of years. I'm talking almost 20 years in the VOO, and it has done incredibly well. So guys, drop it in the chat if you got some questions. Do you invest in dividends? Are you looking at growth stocks? And of course, avoid the noise. I cannot stress this enough. I get so many comments. I get so many messages over on Discord and a couple other places. Guys, the noise has always been there through the investing journey. It will always be there, whether you go 5, 10, 15, 50 years in the future, whatever it is, the noise is always going to be there. And for this, to simplify it, I automate it. Now, if you've watched my channel for a little bit, I do zero-based budgeting, meaning that I take my paycheck, I pay all of my liabilities. Everything that I have left goes right into that investment account. And that is how I've actually got it built up so fast, is to automate what is going to that investment account. And every 2 weeks when I get paid, I do put X amount of dollars up in there because, of course, the best investors take the emotion out of investing in the entirety. I dollar cost average, and I've dollar cost averaged for almost 20 years in the portfolio. And right now, when I look at all of my net worth, it's about 1.8 million. I believe I have around 1.2 that is invested in the market itself. So it is definitely growing, and the dollar cost averaging has absolutely 100% paid off in its entirety. Now, once you start investing, step number 4 that we're going to go over is protecting and growing your money. Now, this is diversification. A lot of people And this is where I really say ETFs are where the game changer is. Since the ETFs have come out, and we know the first ETF was that SPY, don't gamble on one company, don't gamble on one sector. If you want to do this, it is going to be a very, very small percentage that I would do. For instance, if you're looking at something like the S&P 500, it could be 60, 70, 80% of your portfolio. You might have something in there like the QQQM. You could even put like the SPMO. There are a couple ETFs that you could kind of go off of and really create a little kind of sub portfolio or satellite portfolio that is off of that foundation. You could even put some income in there like the SCHD, and that is going to be super dependent on the amount of risk that you want to take, but it's also going to be very dependent on your age. For instance, if I'm working with an individual and they're 55, 60 years old, they're prepping for retirement, chances are we're not going to put a lot of that into some very large growth ETFs because they don't have a lot of runway. Even though we want to see growth, I would rather see the diversification into something like the SPY, which I know with market weighted cap could be a whole entire video in itself on how it looks with NVIDIA hitting that $5 trillion mark. But overall, you might want to supplement with something like the SCHD, where you're getting that 3.6% return, and overall supplementing income when it comes to retirement, supplementing Social Security. It really does make a big difference on the portfolio on where those percentages really lie. Now, of course, mixed growth, you could do, like we said, the S&P 500. You could do something like the VOO if you're looking for income. There's a lot of different ETFs. And if you really want to get crazy, a lot of places are doing covered calls. Do your own research with all of this. Have to make sure 100% you know exactly how covered calls work, what the exposure is, what the risk factor with those are, because they have been popping up everywhere. When you look at the investing landscape and when you look at ETFs, covered calls have been going nuts with stocks, with index ETFs, with so many different things that have been crazy. And it can give you a little bit of exposure, but again, there could be a big downside to some of those. So make sure, again, when you do your own research. Now, of course, when we start looking at something like the VOO, if one sector starts slowing down, another sector could be picking up. This is where we've seen the shift where, these tech companies have absolutely been running. Then they start doing a little bit of a pullback. Then we see the financial setup, sector really moving up, or we have something like the financial sector, or the energy sector that we start seeing up. It's interesting because the portfolio in its entirety will continue to move forward. And if you're getting dividends, reinvest them. I cannot stress this enough. When it comes to the reinvestment in dividends, this is how the compounding turns really good portfolios into absolutely great ones, absolutely growth machines when it comes to reinvesting. So not only are you getting the growth out of something like the S&P 500, every quarter when it pays dividends, you're reinvesting those dividends right back into that portfolio. So now you're getting the growth and you're getting the dividends that are buying more shares to compound the growth factor, which is awesome. This is where, again, they talk about the eighth wonder of the world. They talk about the compounding factor, and that is exactly where it gets in. So do you own any single stocks, guys? Is there one ETF that you do, one stock that you hold that are paying dividends right now? Definitely share it in the chat. I want to hear from you guys, and we'll get into step number 5, breaking this down, which of course is that compounding aspect. When we start looking at this, this is where wealth and accumulation of those assets actually does happen. Compounding is where you take your portfolio in X number of years, it is going to double in value when you start reinvesting and compounding all of those dividends that get there. So when you think of really the trifecta of investing and buying assets in general, so think about it for a minute. For instance, if I want to invest in the S&P 500 and I'm putting, let's say, $100 a month in there, I'm doing dollar cost averaging. So every single month I'm putting $100 in there. At the end of the year, I should have $1,200 in contributions that are going in there. Then you couple it with the growth factor in there. If the S&P 500, let's say on average, we see around a 10% growth rate, your money is going to generate more money. Then you compound on there the dividends that are buying more shares. So even if you're putting that $1,200 into that ETF, like the VOO or the S&P 500, You have the growth factor that's in there, and you have the dividends that are going on top of there. When you start looking at charts and when you look at something like the compound interest calculator, it goes parabolic if you have an extended amount of time. We're talking the 30, 40, 50 years. Your portfolio can be worth multi-million dollars over a extended amount of time, which again, that's exactly kind of that premise of the psychology of money when it comes to being able to invest over an extended amount of time or an extraordinary amount of time. Compounding is what turns your portfolio and your investment and your assets into just an unstoppable machine. When you reinvest invest the dividends, you reinvest the gains, money starts earning money on itself. That is where you start seeing that exponential growth with the portfolio. A very small amount left alone for an extended amount of time will become massive if you wait long enough. For example of this, guys, $500 a month at 8% will turn into almost $750,000 in 30 years. That's before any raises or increases or anything. That is just taking a baseline of $500, 8% return over an extended amount of time, like 30 years. You are, $750,000 at that point. Compounding is the eighth wonder of the world. It is the point where these portfolios are going to go absolutely parabolic when you start building them out. Now, of course, when you do this, increasing contributions over time, this is where we scale the game when it comes to purchasing assets. Wealth doesn't stop when they start investing. They increase their investments over time. Now, a good example of this, let's say you're 22, you're 24, you started in your career, you start putting a certain percent, company matches 4%, you put in your 4% into that 401k, you start entry level, you're making 40 grand a year, you're feeling great, you have a ton of money, you're putting away that 4%. Imagine if we did more. Imagine if we could scale this. Let's say instead of that 4%, you put in 7, you put in 10, you put in 15. Even at a $40,000 job, then you get a raise. All of a sudden, you're putting in 10% of your portfolio. You have that $40,000 salary that you're making. Now they raise you up to, let's say, 47. You're still putting in that 10%, or even bumping it up to 11 or 12. Then you get another raise. You get a promotion. You've been there a couple more years. Now you're earning $67K a year. It continues to exponentially scale as your income increases through time. Every time you get a raise, every time you get a bonus, every time you get a side hustle check, like right here on YouTube, invest it. For me, all of the memberships, all of the AdSense, all of the revenue generation through this channel, I invest 100% of this. We started this channel a significant amount of time. By the time it was monetized, everything that I invest or everything that I earn within this channel itself, all of the contributions that you guys make, and thank you for them, I invest into my portfolio in the entirety. Even if you boost your monthly investment, let's say 5, 10, 15, 50, $100, you can cut years off of the wealth journey, having the ability to be completely debt-free and also generating more than enough revenue to create generational wealth. Now, I call this the wealth snowball. Once it starts growing, once you start the contributions, it will get massive with regular contributions through dollar cost average. So let me know how much you're investing, guys. That's always a question that I get because it's interesting, because when I look at some companies, even that offer a pretty good matching program, we have around 70 to 80% of people that actually do contributions into the 401k, which means 20 to 30% of people are contributing zero, even though there is a 100% match or a percentage match when it comes to the portfolios. I don't understand the logic. If you ever want the ability to retire, to not work, to not have to worry about work, to have the accumulation of assets, the 401k match is a absolute terrific way to get that done. Now, of course, now that your money is compounding, we're seeing the growth. There is one more final step that takes long-term wealth builders and really slingshots it, which is the consistency. Like we said at the very beginning, guys, it is the noise. Here's the truth. Markets are going to go up. Markets are going to go down. And of course, most people lose a ton of money in the market, just like they did in the crypto market, because they react emotionally when they see it really go up or down. Now, when we think bigger picture in the stock market, and if you zoom out, I always talk about this when it comes to portfolios, you have to zoom out. If you start looking at the stock market on a day-to-day basis or even a week-to-week basis, you'll see the ups and downs, and this will panic a lot of people. Emotionally, they cannot stomach the ups and downs. Now, it's interesting because they've done a lot of studies, they've done a lot of surveys. When you look at individuals contributing to a 401k plan, people will spend months, even years, never looking at the balance of the 401k, not knowing where it is, not knowing how it's growing, not even knowing how the 401k performs. On the flip side of that, people will open individual brokerage accounts. They will check them every day. They will check them multiple times a day. They will be looking at that thing like it's literally just waiting for paint to dry, waiting for grass to grow, sitting there and staring at it and watching it go up, watching it go down. And then, of course, you couple that with the news. When you look at the news, a majority of the things we see, whether it be social media, whether you're actually looking like an NBC, CNBC, anything like that, most people will gravitate, again, emotionally towards the negative that we see. Everyone is saying the markets are going to crash. If you look back through all of time, there's been ups, there's been downs, there's been pullbacks, there's been recessions, there's been housing market crashes, there's been dot-com bubbles, there's been COVID. There have been so many things through all of history, and that is why staying invested in the market will always beat selling and buying and trying to time the market. You will absolutely crush your portfolio if you're trying to buy and sell and really time the market in its entirety. The wealthy don't panic. They stay very consistent when it comes to investing and focusing on the long-term goal. That is the reason why the very first step that we talked about in here was the mindset. You have to know the why. You have to know the reason why you're investing. For me, it is to retire early. I plan probably another 5 to 7 years to retire early. And how am I going to do that? Through consistently investing, through consistently building and buying those assets in the entirety. Getting to the point of doing that does mean at my age, I'm investing a lot more money, a lot faster. Roughly right now, you talk about the FIRE movement, I'm investing about 50% of my income in its entirety because we literally have one asset that we still owe money on, or one liability, however you want to look at it. That is the house, and being at roughly a 2% interest rate, I am in no need and no hurry at all to pay this thing out. When I look at my portfolio with the S&P 500, I am earning an 18% return so far this year on my portfolio versus a 2% mortgage that I could pay off. And of course, the portfolio has grown to the point that I could pull the trigger, pay it off whenever we need to if things go sideways or south. We have more than enough in a lot of different places that, again, we could pay this off in the entirety. So if you keep invested really through those ups and downs, you win by default. The extended amount of time in the game with the accumulation of assets making consistent contributions, just like a 401k plan, you will win and you will build wealth and you will generate an incredible amount of wealth. Now, when we start thinking about the long game, checking your portfolio roughly every 6 to 12 months, once to twice a year is really all that you need to do. Make sure you're on track, and really the set it and forget it portfolios are the absolute most successful. You're not looking at it twice a day. Wealth is a long-term game. When we talk about investing in general, runway that I recommend is 5+ years. If you're not willing to set a portfolio, invest in it on a very consistent basis for about the next 5, 7, 10 years, I wouldn't even do it. If you have anything that is a little bit shorter term, if you're looking for a down payment of a house, if you're looking at the emergency fund, if you're looking at vacation, if you're looking at wedding, that is money that does not need to be invested. And I do not recommend for anyone to invest any of the money that is going to have the utilization for those shorter term needs. And again, you could invest for let's say a 2-year timeline. In that 2-year, we could have either a flat market or even a negative market. And now all the money you invested, you're going to liquidate or sell those assets to go ahead and do whatever you planned. Nope, keep that money in CDs, keep that money in guaranteed returns. Do not invest it in its entirety because really it is not worth it at that point if you're using it for a shorter term in its entirety. So of course, guys, there you have it, the 7 steps for building wealth through investing. Number 1, mastering the mindset. That is a huge one. Building that foundation and staying small with those investments. on a very consistent basis in a diverse portfolio, reinvesting all of your gains, letting the growth and really the dividends do exactly what it needs to, increasing contributions over time, and staying very consistent with the portfolio and avoid the noise. I have learned through my career, through investing, through all of the years that I've been doing this, that really the noise is what kills people. When you look at cryptocurrency, when you look at ETFs, when you look at a lot of different things in the marketplace, it will absolutely crush you if you're chasing the news and chasing the news stories in their entirety. You don't need to be rich to absolutely get started, but you need to start to become rich in its entirety. Alfred asks, hi, how much of your monthly salary should you invest? So the target, Alfred asks, is 15%. That is the point that we want to get to. Again, if you're going in and you have something like a 401k that's matching, 4% is really the base. Let's say your company does 15%, and the 15% that we recommend of the monthly salary does not include the matching. So when you think about this for a minute, if you're putting in 15%, and that is what I started to do. So quick little story about what Alfred S. was talking about. When I started and I really got, let's say, my big boy job, where I was actually in a position where I had a degree in finance, went into a financial institution, started working at a local bank that we have here in Michigan. I set it up right off the bat, 15%. It made a game-changing difference. And funny enough, that was roughly 20 years ago. I put in 15%. They matched, I believe at that time it was 4, might have been 5%. So thinking about the portfolio in the entirety, I put in 15%. They matched 5%. I had 20% going in there. And you know what? Very worst case scenario, I overinvest or I contribute too much. But when you start looking at people and individuals that are living longer, so it really makes a big difference, because when you start looking and really looking at data, looking at analytics, looking at a lot of things over the past 30, 40, 50 years, through technology, through science, through medicine, through care, people are living a lot longer. So what we're seeing right now, and this was actually a study, I believe it was from Harvard, if I remember correctly, is people, because they're living longer, they are actually running out of money during retirement because they didn't plan to live 20, 30, 35, 40 years during retirement. That was never the anticipation, where most people, again, thinking back 50 years ago, the mortality tables have updated. They are always changing. People are living a lot longer, meaning there is sometimes a lot more of healthcare costs, but there's also a lot more costs in general when you look at housing, when you look at elder care, when you look at assisted living, things of that nature. I would rather fault on the side of investing that 15% of my monthly salary every single month and having more than enough money to carry me through all of retirement, or even having more money or enough money that I can leave money to my kids, start building that really thought of generational wealth, leaving funds to my heirs, leaving it to my grandkids, being able to cover their educational expenses. Me personally, like I said, I would rather really err on the side of having too much saved. And I don't mean save everything in your entirety, and really not saving so much that you really miss all of your life in the entirety. And that's where, again, it does kind of come down to a fine line, where I don't want you and I don't want your budget to be so strict that you never do anything in your entire life. But if it fits in the budget and you can plan for the budget, for instance, we love going on vacation. We have a budget. We put a couple $100 away every single month that is going towards a vacation fund. When we get to a certain point, our vacation is fully funded. I'm not doing credit cards with it. We're not doing unsecured loans. We're not borrowing money to do it. We are getting to the point where you can fully fund your life without having to borrow money, which means if I spend $5,000, I'm spending $5,000. It's not, hey, we spent $5,000, but we borrowed it. Now we have to pay $7,000 back because we have interest over the next 5 years. Nope, not at all. We're paying cash, even looking at a new vehicle, paying cash for it. And in its entirety, guys, it is really the mindset where I do not want to pay interest because I know the time and effort, and really the time is the big one that I have to do when it comes to being able to pay interest for 5, 6, 7 years on an automobile, how much that's eating up. of the time that I have to work to actually do that. Now that tech is pulling back, what sector are you pivoting to? Should I double down on tech? So me, WB, I'm not changing. My portfolio has a lot in tech. Even my financial advisor, which I work with in my building every single day, says I have a little bit too much risk in my portfolio. But when we start looking at the S&P 500, and again, I use averages. A lot of the S&P 500 is in tech companies. A lot of it, you have your NVIDIA, you have your Microsoft, you have your Apple, you have your Alphabet. All of those big tech companies are really focused around AI, artificial intelligence. A lot of companies are in the AI space. Even if we see a pullback, and I am hoping personally in my portfolio that we do see a 5, maybe even 10% correction within the tech space, because I dollar cost average in that portfolio every single week. Every week I am putting money into there, meaning if we see NVIDIA pull back 5%, I'm buying it at a 5% discount. If Palantir goes down 7% today, or if we see it again tomorrow, I'm buying Palantir at a 7% discount. Again, it comes back, DVB, to the accumulation of assets, not what they're worth today. Because just think of it, what NVIDIA does worldwide with GPUs and artificial intelligence for data centers, all of that, it is about the accumulation of assets. If I have the ability to invest another $50,000 for the rest of this year, I absolutely 100% is going to be investing into tech, as well as everything else that is within the S&P 500. So the energy sectors, the financial sectors, the tech sectors, the consumer discretionary, everything else in that S&P 500, that is the foundation for my portfolio, is the S&P 500, which it should be for you, regardless, again, if it's the VII, or if it's the VOO, or if it's the SPY. Investing in the S&P 500 gives you exposure to the 500 largest companies in the United States. If some of the companies don't make it the cut, or if they get bought out, it is replaced by new companies in the S&P 500. That is why over the last, and I believe it's around 100 years, we have seen roughly a 10% return in the S&P 500. Nothing to say that for the next 100 years, we're not going to see another 10% growth every single year for the next 100 years on average. Now, like we said before, there are going to be down years, but just like we've seen in 2022, and this it is really the proof, and this is where it made a game-changing difference for me, is I was investing in dollar cost averaging. We were doing this for an incredible amount of time. 2022, the S&P 500 was down, I believe 20+% at that point. I bought the S&P 500 all the way down. Every single week, we were dollar cost averaging. We were buying it every single week. Monday morning, I had automated, and I automate all of my investing in the entirety. Automated purchases within the S&P 500 every single Monday morning. Then, of course, we bought it all the way down, getting it at a 10, 20, 22, 25% discount in the S&P 500. Then you look at 2023, double-digit returns. 2024, double-digit returns. 2025, double-digit returns. I have absolutely crushed in the portfolio. The portfolio that I have, and if you watch the portfolio video I did, I've been invested for 4 years. And again, the foundation in there is that S&P 500 fund. We are up, and I believe this morning it was 111% up, even a little bit more within that S&P 500 fund, because as it grew to around a $200,000 portfolio, I added a couple little satellites in there. We picked up some of the QQQM, which again gave me a little bit more focus into tech. Picked out some of the SPMO, also did on the GDE, which is the gold futures, as well as some tech in there. And we also picked up Bitcoin. I wanted some exposure to cryptocurrency. I don't want to own them. I don't want my cold wallets. I don't want the storage. I've done that before years and years ago with cryptocurrency. So my exposure is through, and I believe it's the IBTC. It's the Fidelity Bitcoin Fund. Again, I wanted some exposure, and 10% of that portfolio did go into Bitcoin. I know it just dipped up to 100,000. But again, when you think of investing, you are thinking long-term. For me personally, like I said, I'm 45 now, thinking of 65, 20 years down the road being an actual retirement age. I want to retire earlier. So I'm even looking at what is my portfolio going to look like, and where can I grow these assets to in the next 10 years, if I want to retire at the age of 55, what is it going to look like with this portfolio within the next 10 years? And how big, how fast, how much compounding can I see within those next 10 years? Even if the tech market, like I said, if tech AI does pull back, if we see 5, 10, 15% pullback, absolutely, I am going to be pulling and I am going to be buying tech the entire time, just waiting for the comeback, because we know it's going to happen. Now, a lot of these ETFs, like we talked about the SPMO, even looking at a few, they are passive in the methodology between the ETFs, but it changes every 6 months. So that's kind of, and again, do your research on some of these ETFs, guys, where they're going to buy and sell out of positions based on the rebalance that they do. And most of them do semi-annual rebalancing. And I love some of these, and they've been doing incredibly well. I own a pretty good stake in tech in the Van X Semiconductor Fund, the SMH, which is shake my head, which is funny that that's the acronym. But again, that's another really good ETF. Semiconductors have been absolutely crushing it, even outside of the AI space. There isn't anyone I know that doesn't use computers and smartphones that have some access to what they need for semiconductors. And it's really a good fund that has been producing, I believe, around 33% every single year over the last couple of years. It's been kind of incredible. So yeah, I mean, like I said, me personally, I'm doubled down on tech. I still have my portfolio. It's all the way built out. If you check the portfolio, I know there's a video. Actually, let me hop over and I'll link it because I shared it not too long ago. I'm trying to think exactly where the portfolio is. I'm going to have to find it. But yeah, it wasn't too long ago. Maybe I did it as a live. Maybe I did it as a live stream. But again, I shared my my entire portfolio on there, so you can go through and build and check out. And I believe it was a live. If you look at the lives, I went over to M1 Finance, where that's where I do all of my investing, but I covered the portfolio in the entirety. You guys can check it out and see exactly what I'm invested in. I cover it usually once or twice a year, that we know exactly what we're investing in and what that kind of does look like. But definitely, guys, it's awesome to hop on here. I want to try doing the lives probably at least once or two times a week. I love being able to chat with you guys, and I know as the channel grows, as a lot more people join us, a lot more questions will come in, but we'll definitely get all of them answered as they do come in. So of course, guys, if you found value in tonight, definitely let me know in the comments. Hit the like button, subscribe to the channel. We are doing videos on a daily basis. Even hired an editor, Daniel, that is taking care of a ton of the videos for me, which is awesome. I want to do a lot of deeper dives like this into passive income, which we did, building long-term wealth, and of course, drop your biggest investment goal for 2025. Even going into 26, drop them in the comments, guys, so I can see and I will answer them. I do go through and answer all of the comments that come through the YouTube channel. So guys, that's going to do it for today's live stream. I know we're a little bit over, but absolutely, it's so fun doing YouTube. It's something that I wish I probably would have started 5 or 10 years ago, but I absolutely love to come on here, talk to you guys, share a lot of insight, and answer questions if you guys have them. So again, that's going to do it for today's live stream. Guys, let me know in the comments what you guys think about the stream. And as always, thank you guys for watching.